Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, this week we saw global markets notch fresh highs. Again. What's fueling this persistent optimism?
It really comes down to growing conviction around rate cuts. Over the past few weeks, we've seen a notable shift in tone, both from policymakers and the market itself. Futures markets are now pricing in an almost certain 25 basis point cut from the Fed by October, and there's even some speculation that we might see a move as early as July. That optimism is rooted in two things. First, the data has started to soften. Core inflation is easing, oil prices are coming down, and consumer confidence has taken a meaningful dip. Second, there's political pressure. With the U.S. election season creeping up, the narrative around easing policy is becoming more forceful, especially as concerns about tariffs and economic momentum build. So it's not surprising that the S&P 500 and Nasdaq have pushed to new highs. But to understand the full picture, you have to look beyond the U.S., because the real story may lie elsewhere.
You're referring to Europe, I assume? The Euro stocks numbers are hard to ignore.
Yes, they're actually remarkable. In US dollar terms, the Euro Stoxx 50 is up around 23% year to date. That's miles ahead of the S&P and Nasdaq, which are both sitting near 5%. What that tells us is that investors are finally starting to notice the valuation gap. US equities are still expensive, very expensive. They're trading at a substantial premium to European peers, and unless the big tech names in the US start delivering strong upward earnings revisions, it's hard to see how that premium holds. So far, only Microsoft and Alphabet have actually seen consensus earnings move higher this year. The rest of the so-called Magnificent Seven have seen downgrades, which is not exactly the earnings leadership you want heading into Q2 reporting season.
So with earnings season around the corner, should investors be nervous?
There's definitely some unease under the surface. We've already seen more than 30 large U.S. companies pull or suspend full-year guidance. These aren't fringe players either. They span tech, autos, airlines, retail. That kind of behavior usually signals a lack of visibility, not confidence in future growth. And then you have the consumer data. The Conference Board's Consumer Confidence Index dropped again, falling to 93. That's a meaningful decline, and the expectations component is now well below the level that typically signals recession risk. People still see jobs available today, but they're starting to worry about what lies ahead. That anxiety filters into corporate sentiment and eventually into earnings.
Let's talk about the Fed. Are we really heading for a July cut?
It's suddenly not that far-fetched. Just this week, Susan Collins from the Boston Fed joined the growing list of officials signaling that a cut could be on the table as early as July. Though, of course, it depends on how inflation and the tariff situation evolve. What's really adding fuel to this is the chatter that President Trump may announce Powell's replacement sooner than expected. That adds a whole new layer of uncertainty. And when you combine that with lower oil prices and softening inflation data, it's easy to see why markets are leaning more dovish. Still, the labor market remains relatively solid. We're expecting the next jobs report to show unemployment around 4.3%. That's not exactly a crisis number, so while the narrative is shifting toward cuts, I'd say a July move is still a toss-up at best.
Let's pivot to the dollar. It's quietly slipping again. What's driving that?
There's more to it than just rate expectations. The dollar's decline is also being driven by political risk, and that's something we haven't had to factor in for a while. If Congress remains paralyzed and judicial checks weaken, investors start to question the long-term institutional integrity of U.S. governance. That matters because, for decades, U.S. assets have carried a premium, not just because of economic strength, but because of legal stability, transparency, and trust in institutions. If those foundations come under pressure, that premium gets reassessed. The dollar's slide reflects that slow but steady reappraisal.
That's it for this week. Stay tuned for more insights next time.